Ask Abby, providing answers, insights, and education designed to give you the tools and knowledge you need to thrive financially and live confidently in retirement.
And welcome into the program, Ask Abby with Abby Reed of the retirement family, the Reed Financial Group. And Abby is here providing guidance and perspective on complex financial, investment, and retirement planning issues. You can submit your questions if you'd like to hear them answered on the program, or if you would like to discuss them individually with Abby at the website, goaskabby.com, or by calling Reed Financial Group 678-442-0255, 678-442-0255. We did recently have a question submitted on the website, Abby. My husband and I are planning to retire and move to Tennessee. We are having a home built out there, should be completed later this year. We are planning on living there full time by next year, hoping the new buyers will let us stay and rent back for a couple months. My question is, when we sell our current home, are we going to be hit with an exit tax? I don't know much about that. Would like some insight. I'm sure an accountant can advise, but they're hard to pin down. Yeah, especially right now, it's tax season. I'm just trying to get as much insight into the sales process as I can. Thanks in advance. So the gist of the question, Abby, when you sell your home, are you responsible for paying a large amount of tax on the profits? And a lot of us have good equity built up in our home and profit now.
Especially these days, the last couple of years in particular. So this is a pretty common question because a lot of times when people retire, they are going to want to move. They're going to want to move closer to their kids, their grandkids. They're going to want to go to Florida. If you're in the north, you're going to want to come Georgia. We're seeing a huge influx of retirees from all over the place. Our weather is nice. Cost of living is pretty good. So it's a really common thing for people to be doing right around retirement. So go back to answering the question. There is an exclusion. It's called the Section 121 exclusion for a primary house. So you can exclude, if you are single, it's up to $250,000 in capital gains. If you file a joint return, it is up to $500,000. So either 250 or 500. That can be excluded from capital gains if it's your primary residence. So there are some stipulations there. You have to have lived in it as your primary residence for 2 years over the past 5. There's some other things that the criteria that need to be met, but to keep it pretty simple, if that's your primary residence and it's not an investment property or a vacation home or something like that, you're going to be able to exclude those gains. If it is a vacation property or if it is an investment property, like a lot of my clients these days, especially have rental houses, Airbnbs, they're very popular. Those have completely different rules. But if it's your primary residence, you can exclude that. And so it's actually a pretty nice benefit because it's kind of like an investment. But typically you would have to pay tax on all of those gains if it was in, an investment account, but you get to exclude that. Otherwise you would have to pay capital gains tax on it. And as long as you can do that pretty much each time you sell your primary residence, it just can't be within the first 2 years. So if you've already excluded some gains from a different primary residence within the past 2 years, you're gonna run into some issues there. But most of the time, that's not going to happen. So in general, those are kind of the rules and what you need to know with that.
The investment in the roof over our head can be a pretty advantageous one from a tax standpoint.
Yes.
That's a good amount of profit that we can make on our primary residence and exclude it from our capital gains or taxable income. But that is one of the differentiating factors, is that it has to be the primary residence, can't be an investment property. Investment property purchases and sales and profits are going to be taxed much, much differently than our primary residence, it sounds like, Abby.
Yep, exactly. So if you are looking at selling any kind of property, residence, but especially with investment properties and vacation properties, that's when you're going to need to do some some tax planning, because you're going to sell that house. You're going to owe capital gains on the or capital gains tax on what you've gained. And, eventually the IRS is going to want you to pay that. So you need to be aware of that, obviously.
They sure are. Now that does bring up another point, though, Abby, is that, and I know this is not part of this individual's question, but for investment property and investors in real estate, there are some other parts of the tax code that they may want to look in before any major sale that can provide some tax advantages there. It's why real estate is one of the favorite asset classes and has really created and helped so many millionaires.
Yes. So with real estate, with investment properties, and we won't get into too much of the weeds here, but it's a really good kind of just high level thing to keep in mind if this does pertain to you. So if you have an investment property or you have a rental property, or, however you think of it, Airbnb, that's going to be classified as an investment property as far as taxes go. So say you are wanting to sell one of them and there's a substantial gain because the market has had this crazy run up, especially in the past couple of years. But your plan is to eventually buy another one, maybe just a different opportunity, a different location. There's a way to structure that so that you don't have to pay gains on you can almost transfer the funds from that first real estate property to the other one and reduce taxation on that. So that's a very simplistic explanation of that. But if you are in a situation like that, talk to your, advisor, give us a call. We would involve a CPA. We have a network of CPAs to make sure that everything is done properly. And it's legal. It's in the tax code. They want you to do this because they want you to continue to make investments. And so that's why it's in there. You just have to make sure that you do it properly. But it could save, thousands and thousands of dollars on unnecessary taxes. So it's a huge benefit.
Lots of opportunities within the tax code. Unfortunately, a lot of us just miss or overlook or don't dive in to really strategic, proactive tax planning. And a lot of us aren't receiving that kind of advice, but certainly something that it's not what we have, it's what we get to keep. It could make a big difference in our holdings, in our profits, in our retirement accounts, all of those. And for the sale of this house and hopefully to this individual's appreciation, probably going to be able to exclude a large amount of gain and profit on the sale of the primary residence. So that's section 121. Abby, appreciate you sharing that with us. Always good information. And if you have questions of your own, feel free to submit them on the website, goaskabby.com. Let us know if we can share them on air, or if you would like an individual confidential answer, a discussion with Abby one-on-one. Again, you can get in touch and submit those questions at goaskabby.com, or you can give Abby Reed and the Reed Financial Group a call, 678-442-0255, 678-442-0255. Once again, Abby, always appreciate the education and insight that you share.
Absolutely, Peter. Thanks for having me.
Here to answer your financial questions, visit the website goaskabby.com for show resources and to submit your questions and get answers, or to schedule your complimentary financial investment and retirement planning strategy session. You can also reach out to Abby directly at 678-442-0255. That's 678-442-0255, or at goaskabby.com.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM and Reed Financial Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. Third-party ratings and recognitions are no guarantee of future investment success and do not ensure that a client or prospective client will experience a higher level of performance or results. These ratings should not be construed as an endorsement of the advisor by any client, nor are they representative of any one client's evaluation.